Good afternoon, UK. This is Tim and Chris on the buzz, as always on Thursdays. Now we're talking finance, business, tech, entrepreneurship here. You know where to be on Thursday afternoons. Get that dose of information or knowledge for yourself. Keep your pockets full. Tell a friend to come listen as well. We're talking about investments today. We're talking about where to put your money, how to discipline yourself for your older self to thank you in 5, 10, maybe even 50 years. Uh, I Chris, thanks for joining in today.
Hey, Tim.
Awesome. How are we doing?
Yeah, we're good, man. England won the football last night, so I think everyone's pretty
Mm,
happy. So it's all
aren't we
good.
all? Aren't we all? But there's been a bit of a crowd going all over the place on this for celebrations, and there might be a chance of locking things down. Apparently, right?
Yeah, look, it's going to be a super spreader, right? We know this. Wembley, so it's to be expected, but we'll see how it goes. No one's thinking of that now. So
Can't blame them though.
yeah, yeah.
um, yeah. So what have we got in store for today, Chris?
Yeah, look, investments always an interesting topic for people. People think they know what they're doing, and most of them don't. So I think let's just go through what investments actually are and how complicated it can be, and where some of the pitfalls are for people, and what can you do to start investing, because it's a good thing, right?
Yeah.
If done properly. So yeah,
This is
it'll be pretty interesting.
Yeah, we actually got a conversation that a lot of people have started to consider doing as of early last year, considering the
Yeah,
pandemic, considering having yourself a safety cushion, regardless of what you're doing, where you are, which position of a company you are at, if you're the owner or even an employee. Yeah, so let's dive right into it, Chris. Let's start with what an investment is, how to start with it. We're ready to
yeah.
go.
So okay, most people think of investments as stocks and shares, or something that you need to buy from a bank or a stockbroker. It's not necessarily the case. I mean, if you're an entrepreneur and you put money into your own business, that's an investment. So, we have that famous saying, the return of investment, and that's exactly what it is. But for most people, if you're on PAYE or just in a job, your investment portfolio will generally be stocks and shares that are traded on the stock exchange. The reason for that is that they are liquid, i.e., you can sell and buy them pretty easily. And also, they are legitimate, because let's not kid, there's a lot of things that can go awry out there. And we'll touch on a few of those as we go through the program.
Awesome.
The other
Awesome.
investment that people have as well is buy-to-let properties. Your own home, we don't see as an investment because you're living in it. Yes, you may put capital into it and you may make it better in the hope that it appreciates in price, but don't see it as an investment, and don't treat it as your main investment. Treat it as your home. So the money you put in is for your comfort rather than
Yeah.
for your return. And I think that's an important distinction for people.
Yeah.
What is, yeah.
As young business owners, I'd say, when it comes to, not age wise, but when it comes to you being a business owner, and there's a lot of experience. It's at the initial part that you're the most brave, and then um you know as risk increases, your fears increases. I was just reading an article about how Jeff Bezos has stepped down as the CEO of Amazon, and
Yeah.
Andy, the new CEO. This is, it was basically on what he talks about, business, taking risks. He basically says how, where you put your money, these things all matter. Now, let's say you generate a cash flow positive business, and your questions are, things like, maybe we can jump into it later on, but we definitely do have a while today. So we'll, I have a question. If you are, a business owner, do you reinvest your money immediately, or do you, put it into other assets or investments? What do you do there?
So here's the interesting thing. Most business owners that I know, successful business owners, will reinvest in themselves, i.e., into their business or into another business venture that they will start primarily because they believe, and rightly or wrongly, it doesn't matter, that they can generate a better return than someone else can, right? Which, if you're a successful business owner, is a kind of a fair, let's call it a fair bias. It doesn't mean to say that you will generate more returns or not, because no one can say that. However, remember what an investment is. An investment is the basis of giving money to someone else to grow it. And basically what happens is that money goes into a company. Let's say I'm your investment manager, and I put it into a company that's listed on the stock exchange because I believe the management, or the people who are running that company, can distribute those funds in a way that makes the company more profitable, which will give us a better return or higher share price. So you make money on it. And that's the basis of it. So as a business owner, a lot of them say, hang on, I can actually distribute and manage that money more effectively within my business or another business that I'll start, and I'll get a better return. And, and it's perfectly okay. So their main investment would be their own business. But let's say going to where you're trying to get to, I think, is that you get to a stage where the business owner may believe that, but he wants to put the money elsewhere, right? And invest it somewhere else. You've got to be very careful, because there are specific tax rules around this, and specifically around when you sell your business, because there is business relief and various tax incidences that can hamper a business from investing too much of their money in other investments to generate more money, if that makes sense. And it's all done on there's no set rules, but there's a base we have to look at. So that could also hamper that side. So then they'd take the money out into their personal capacity, pay the income or dividend tax on it, and then invest it in a personal capacity. And sometimes it's a better way to do it as well. And the reason they would do that, let's go on. I mean, let's just shuffle down the road here a bit, because I want to talk about risk, because I think risk in investments is an important discussion, and you can't talk about risk without mentioning diversification. And for a lot of people, they hear this word diversification, they might kind of think they know what it is, and they probably do, but diversification is basically spreading your investments over a wide variety of asset classes to manage the risk of that portfolio, because no one knows if equities are going to go up tomorrow, or property is going to go up tomorrow, or bonds are going to go up tomorrow, or, no one knows how that's going to be. So what we do is we spread it around. And how this works, I'll get a little technical, so jump in, Tim, and stop me, as you usually do, because I start rambling on, right?
Awesome.
So when we look at investment, we look at, there's two primary bits of information we look at, and we use the Greek letters for this. So we look at what's called alpha, and we look at what's called beta. Now, alpha is the amount of return that a fund manager gets over and above the market return or their benchmark. So I'll break that down a little bit, because if I'm an equity portfolio manager, and so I've got a portfolio of, let's say, mainly UK equities or traded shares, I have a benchmark against what I need to perform, right? So how am I performing relative to something else? And for this example, let's say it's the FTSE index, right? FTSE 100, because I've got many large corporations, and that kind of works. So I need to have a positive alpha. Basically, the FTSE does a 5% return in a year, and I do a 7% return in a year. My alpha is 2%. Okay, I've outperformed my benchmark by 2%. Now, I'm oversimplifying this massively. I'm probably going to, if there are any fund manager friends of mine watching, they'll phone me in a second and tell me off. But so, and there's quite a lot of complicated math that goes into that. But how I assess fund managers and investment managers on behalf of my clients is we generally look at how their outperformance rates and ranks. Now, that alone can't tell you whether the investment is good or not, or whether their portfolio is good or not, because how did they achieve that alpha? Basically, what volatility did they use to achieve that alpha? And is that sustainable over the long term? So we use beta. So you have to have your alpha before you can work out your beta. And beta is basically the risk of the portfolio relative to its performance, which is important, right? Because all portfolios then, even if they're equity portfolios, have a different risk rating. And that's important for a couple of reasons. It allows me to use those figures to match the investment with my client's risk. Because everyone has a different risk basis and they have different goals. So we now have the alpha and the beta in hand to say, okay, are they outperforming, and are they outperforming in a risk that is tolerable? Because you don't want too much risk, right? So you got to play one off against the other. Now this is investment risk, so it's different to a person's risk or a person's willingness to take risk. Okay, so that's the one risk category. Then we speak to people who are actually investing their money. Is that okay, Tim? Do you understand that? I mean, I don't want to go shooting ahead.
No. Yeah. So you can keep going. You can keep going.
So a person's risk has two elements to it. They have the risk they're willing to take, i.e., you can ask someone, how do you feel about the market? Well, I'm pretty confident about it. I know what I'm doing. I've read books or even I've been a professional investor. Okay, how do you feel about this pot of money, whether it's a pension or an ISA or another investment vehicle? How do you feel about that pot of money losing 10, 20, 30% in any given year? And this is different, right? Because for a pension, you may have 20, 30, 40 years till you retire. So that's okay. So, in 1 year, I can take a 30% hit because we've got time to recover. But this ISA, I'm actually saving up for school fees, and I'm going to need it in 3 to 5 years. So no, I can't take that kind of hit because we don't have the time scale to make it up. So the time scale of the investment is very important to the willingness of the person to take a risk, right? And this is the risk of markets going up or down. And remember, if you've got everyone has this, okay? No one has the expectation of getting more returns, or you might think that that's what they would have, but everyone has the aversion to loss. So rather than expecting greater returns, people expect less loss. That's the kind of psychological bias for people. So you've got to make sure that you limit that for them. And we can do that through diversification. We kind of can stick it in the corridor. Yes, it goes out now and again, but for most of the time, the math works. So then you talk to the person and say, okay, you're willing to kind of take this level of volatility, which we know. So if it goes, I know if someone can only tolerate a 10% downfall, then they're not going to participate in all the upside of the market, because we have to use asset classes to protect that, which will then dampen the upside, right? Makes sense. Yeah. So you have this corridor. Then I look at the person's capacity for loss. Now, this is the second part of the risk equation. So the first part of the risk equation is how willing are they to take the risk, and what is the time scale for that risk, right? And then the capacity for loss has another look. It says, okay, I know what you're willing or you want to do, and I know what you want to achieve, and I know the time scale you want it in, but can you actually do it? I.e., what are your assets in the background? What is your background? How stable is your job? How stable is your home life? And all of that kind of useful information. Because let's say you say, look, I'm high risk because I'm 25 years old. I'm investing into an ISA, and I've also got my pension. But you don't have a stable job. You don't have a stable income, and you may rely on this money sooner than you expect. We may knock you down a couple of risk levels. Just say, you know what, let's just be a little cautious, because your capacity for loss is a little bit low at the moment, and that can always change, but let's be a little cautious. Or can go the other way. Someone can say, look, I don't like risk, I don't want to take risk in the market, but their capacity for loss is actually quite high. So the money they're investing, it actually is not going to affect their lifestyle in any meaningful way, i.e. the way they live day to day, if they take a loss on this money. So we say, look, in order to achieve the goals you need, maybe we should get this risk up one or two notches. And people generally accept those discussions. We don't do a risk. And please, if you go to a financial advisor and he takes out a 1 to 10 bloody risk graph, just say, that's useless to me. You don't want that. You don't want to be scaled on a 1 low risk, 10 extreme risk, because that stops the conversation around it. It stops the meaningful conversation of how much risk you're willing to take. Do you know what the risk is? What is your time scale? And let's have a look at all your other assets and make sure that you can take the risk you want to, or you're taking enough risk you need to. And that's one point. So I don't use 1 to 10. I don't, we can say, okay, you're a medium risk at the end of it, or a high risk or a low, but yeah, so that's it. And then you can build a portfolio or stick them into a model portfolio, which is generally good if you've got a good investment management proposition at the back of you. And then we go on. This needs to be reviewed. It needs to be reviewed at least yearly, especially in changing circumstances. What people don't realize about investments is that investments are not driven through logic. They're not driven through math. They're not driven through rational thought. They are driven through emotion. Most people, and I include myself in this, as an ex-stockbroker, as an ex-investment professional, now a financial advisor, I understand that emotional bias to this investment malarkey. It drives people to make the wrong decisions at the wrong time every time.
It can make you or break you. I completely agree.
Yeah, we did St. James's Place did a study on investor biases and the behavioral science of investors, because there's quite a large client bank there, over 700,000 clients, so there's quite a lot of information, and you can just look at it anonymously and see, and then compare it to the general market. And what we found was that the clients that had a financial advisor to talk them through specifically times of uncertainty, like the pandemic we've just had, like 2011, like the IT crash, like 2008, all of these big events in world markets, to talk them through it and say, look, don't panic, don't sell, don't, if it's appropriate for them, and have that discussion. We're 45% wealthier in their investments than people who didn't have it, because they sold. So yes, you sell. Now you're out of the market. Now where you're not in an investment, you're in cash. So you're losing money on that. But now the other hard bit is to get back into the market. So when do you do it? Because invariably the market will slump, it'll go down. And as we know, it's cyclical, so it'll start to come up. But as it comes up, you think, is it going up, or is it going to drop down again? We don't know. And so you and ah until you get in halfway up the cycle. So you're missing quite a lot. Where if you stayed in and you ride those cycles, it has definitely been better off for people over. Well, it's not even a short-term period. The last 10 years, it's been quite right. But over the last 20 years, definitely, it's been better for people to stay. And an advisor or a professional investor to chat these things through and kind of calm you down and take the emotion out of it has been critical to that.
Give you a sense of reality, or give you a sense of perspective in terms of where you're putting your money, and keep reminding them where they're putting their money into.
Well, exactly. It's going back to say, okay, what was the goal for this, and what was the timeline, and let's just say, has that changed? And if it has significantly changed, then maybe, but most of it hasn't.
Just off topic. What's how emotional do people get, like when there's volatility, or capacity frequencies, in terms of changing? Like,
people get scared.
Is it just pulling out that is the worst thing to do? If you're, let's say, for example, we're talking about stocks here. So if a stock goes down, I'm at least the most familiar with how people pull out of fear, and then that trade eventually turns out to be a loss. How would you say? Maybe we can come into this answer after a quick break, but we'll leave with a quick question around what people do when their stocks get relatively volatile, more volatile than they could expect, and how you should not, how you as an investor or you as an advisor approach that situation or should approach that situation.
Yeah.
Yeah. We have a lot more questions in the lines of where we're looking at going in terms of where to put your money into, because it's not just stocks, like Chris said, that you can put your money into. There's so many other types of investments as well that vary according to volatility and capacity. Stay tuned right here on The Buzz. We're talking to you about investments and why you're not getting rich. This is an important topic. If you want to keep your pockets full, share this video with your friends, your family that are looking to get a little get literate in terms of finance and discipline, so they can thank themselves. They can, in 5 years or 10 years, they can thank you for sharing this video with them. Also, make sure to leave a comment on the video right here below so we can get those questions answered with Chris. We have Chris till 1 p.m. Make sure you're tuned in. This is The Buzz, and you're tuned in on Relaks Radio. Good afternoon.
Climb Mount Everest. That is one of that's in my bucket list. You're laughing, but that is the facts right there. I'd love to do that. That is something I'm looking forward to do, hopefully.
Climb Everest.
Mount Everest. I mean, okay, not the very tip of Mount Everest, maybe the base camp at least.
They're talking about mental health. Well, if you went out and got some exercise in the fresh air, that would improve your mental health. It will make you feel better.
That's true. That is true. I wholeheartedly agree. But then for some people, it's how do you find the motivation to, especially when it comes to riding a bicycle, to do it again and again and again and again? It's a cycle that you have to be used to. How do you do it? What makes you wake up in the morning and decide, hey, I'm going to pick my bike up today. I'm going to cycle. What makes you want to do that?
What makes me want to do that?
Yeah. What do you like? What could you give listeners, like people listening in right now? What kind of tip could you give them?
Well, the first tip I would give them, if you haven't tried it before, try it. It can open up new horizons. It will make you fitter. It will definitely make you fitter. Cycling is one of the best forms of aerobic exercise you can do.
It sounds like, I mean, if you think about it, yeah, it sounds like great fun. Because what essentially you're trying to say is also at the same time, when you, if you look at it from this perspective, with regards to mental health, especially when you look at it with mental health, this is another way to fight it. I feel like you go outside, you meet more people, you interact with, socially, you will interact with more people, and you're keeping fit, you're making connections, you're breathing in the good and exhaling the bad. I feel like that's a great thing right there.
Absolutely. Yeah, you got a better way with words than I have, I'll tell you. But you're quite right. What you say there. I
mean, I've been doing this for quite some time. I mean, hey, you'll get the hang of it.
I'll be doing it for about 10 minutes now, so yeah.
That I can never really understand people staying in one room the whole day when you can have the world to see. I am a traveler. I travel. I love traveling. Traveling is just one of the things I do. And yeah, on top of my bucket list was, to one time, hopefully when I get there, go to Nepal and climb Mount Everest. That is one of that's in my bucket list. You're laughing, but that is the facts right there. I'd love to do that. That is something I'm looking forward to do, hopefully.
Climb Everest.
Mount Everest. I mean, okay, not the very tip of Mount Everest, maybe the base camp at least.
Base camp, yeah.
At least.
Would you be able to cycle there?
Oh.
The valuations that you place on an asset are always behind you. It's always in hindsight. It's never in front of you. And that's one of the challenges, right? Because you're always valuing what happened yesterday. And what you need is what's going to happen tomorrow. What am I saving or investing for? Why am I doing it? When will I need the money? And how much money do I need? Yeah. So that's quite important, because when you're looking at your net worth, you've got to start with saying, well, what do I want my net worth to be, so that there's a goal, and then work backwards. How do I get there? And if I can start with £50 or $50 a week, if I save that every week, and you can go online and use calculators online. I don't have to teach you the maths behind it, but you can say, okay, and if I get a 3% return and I put this away for how long will it take to reach my goal? And that's called just this basic cash flow projection calculations. And it's what we use in financial planning all the time. What we say to clients is we say, okay, what is your goal? What is your objective? Where do you want to go to? And we discuss that in a lot of detail and over most of the meeting. And then the rest of it is saying, okay, in your exact circumstances, with your risk profile, with how you feel about investments and pensions and taxes and where you are and who you work with and, your education level or your lack of education or how involved you want to be. There's a lot of variables that we take into account. And then we say, okay, here's a plan. You start like this, that's great. And then we review it all the time. And we say, okay, we need to increase it, we're on track, we're not, this is what is happening. Because remember, when you're dealing with assets, the valuations that you place on an asset are always behind you. It's always in hindsight. It's never in front of you. And that's one of the challenges, right? Because you're always valuing what happened yesterday, and what you need is what's going to happen tomorrow. So that's a struggle. Yeah. So there are strategies everywhere from £50 a week up to £100 million, and they're different. Right? They range differently from everyone, but and from country to country, to be fair. Different countries have different tax laws, so with different vehicles. But from your point of view, at the sort of normal end, I'm not going to call it the low end because I'm in that boat as well. It's as tax efficient as you can get it. That's where you start. You use all the tax efficiencies, and then you step up into different things.
We're back here on The Buzz, and we've got Chris on the show. Chris has been a financial advisor. He's been in the finance industry for over 2 decades now. And, he comes in every Thursday from 12 to 1 p.m., sharing, a bit of, investment discipline in terms of finance. If you're not tuned in on Thursdays, 12 to 1 p.m., you're missing out. Now, we were discussing how investing is important for you, how it can benefit you down the line, and where, how you need to think. So, we have Chris here. If you want to ask questions, make sure you just pop them up on the comments here. You're tuned in on Relaks Radio. You can call us up on 07852 473 473 as well. Chris, we were talking about volatility and capacity. We were talking about where you need to consider putting your money in. Let's go down that. And we were also I was also a bit curious on finding out where, how you should behave in a situation of, where your stocks don't work in favor of you.
Yeah. So, the emotional side of investing is something that's been studied for years and years and years, all through to how traders deal with the emotions to the general public in what they do. So here's an easy thing, right? If you invest in single stocks and shares, and I don't advise anyone to do this unless you're a professional trader sitting in a big bank with all the equipment, because you just can't. That's like gambling, right? If you're just buying a share, and it's a very difficult thing to do, and that's an opinion, of course. You're going to have a high emotional roller coaster if you have one share or 2 shares or even 5 shares or even 30 shares, because the volatility of that is going to be by its very nature quite high, meaning the ups and the downs are going to happen quite quickly.
Yeah.
And I mean, no, it's gone. It's going to be terrible. You're going to be exhausted just
What's
from,
scary is you don't know when the ups or downs are going to, stop, and up to
yeah,
what levels they can, variate. I mean, yeah,
exactly.
regardless of what regardless of what stock you invest in, you have to be ready for it, right?
Yeah, and it doesn't matter what stock it is. You may think, oh, but this company's been around for 50 years, it's the biggest company on the planet, but the CEO resigns, or a manager does something, or news comes out, or and it goes down or it goes up. It's the same thing, and you'd be surprised that when a share goes up, people do generally get happy. But here's an interesting study done by J.P. Morgan quite a while ago. And I don't know why I remember this, but I do. That what they found was when a person's portfolio gets above a certain point, and they thought it was around 5%, but what the research is finding, when it gets above a certain point, the increase in happiness doesn't happen. So you're not getting happier. What you are getting is more anxious, because now you're worried about losing that extra money, right? So it's an interesting conundrum that does happen. So you get to that point.
I think
yeah.
I know what you're talking about. I studied it a while back as well. It's a graph of your risk averseness, and your how much you have in terms of your capital, or how much cash flow you have, right?
Well, increase in wealth isn't proportionate to increase in happiness. Basically, we kind of know that, right? Above a certain point, you've got to get to a point first.
I'm gonna kind of argue with you on that, though. I read this, and I didn't read, but I actually watched this documentary again on this real estate broker. The guy is basically, he does a ton of real estate. He does a ton of insurance in the U.S., in New York. His name is John Henry Stiles, and he talks about how the $70,000 a year is the tipping point of where people stop getting happy in proportion to how much they earn. And because we do know that, I mean, when you're talking about class,
that's my
when you're
point,
talking about,
right?
yeah. So he talks about $70,000 a year, and till you get to that point, you're doing what you have to do. It's after that depending on everyone's lifestyle, everyone has their own particular style in terms of what they want to live, vacations, clothes, cars, houses. But that's when you start worrying about your next meal kind of thing. That was what I kind of took from it, because there are people wondering, living on a daily daily structure in terms of finances, and there are people living in generational financial literacy. So what's your take on that?
Now look, more money makes you happy up to a point, and that point is different for everyone. So when you are on the breadline, so to speak, or you're living hand to mouth, if you get to a situation where you're now living month to month, I mean, that's nirvana, right? You think that's happy, but then you move the goal again, and you move to year, and then you move the goal again. And for some people, you get to a point quite quickly. Let's say it's $70,000 a year. I don't know. And then it's okay, because more wealth then doesn't necessarily lead to greater happiness. So you save that money and invest it, and you secure your future. Or else you're someone else, and you need $1 billion to have that feeling, right? Because that's how billionaires are created. They need to just keep going and going and going until some don't stop. But for most of us, it generally holds true. Once you get to a certain level, then the rest is just jam. And people think, oh, but I'm going to buy a mansion, I'm going to buy a car, I'm going to buy an island, I'm going to buy a country. Well, you don't. No, you don't do that, right? You buy the car. I mean, I remember when I first bought my first BMW, I thought it was the best thing ever. And then after about 2 months, we were just like, well, whatever. We have this capacity to get used to
that's
it.
true as well. That's true as well. My approach is, it's not, I mean, where I'm coming from, I think the reason I agree with that is, I'm not saying materialistic things make you happy. The approach that I'm taking is where there is a certain threshold that you need to be comfortable with in terms of, cash flow
Yeah.
at least. So yeah,
And when you
I
reach
think,
that threshold, sorry, yeah.
yeah. Go ahead, Chris.
But when you reach that threshold, it's quite interesting because then your psyche changes around risk on the investments, your attitude
Absolutely.
to your money, your attitude to your wealth, because and it doesn't mean your risk will increase. It may decrease. It doesn't matter. It's different to people, but it does tend to change at that stage. And what people can also do is now they can start deferring money for later in life, so they can start securing their future. And then we also start doing intergenerational planning. So yeah, it's a bit of a side topic, but we can go back to the emotional side of the investments and saying don't do shares. I mean, it's very rare that people investing in individual shares, and I'm including things like Bitcoin in this, get wealthy off it. It's very unusual, and it doesn't happen because by the time you or us as lay people outside of the company or outside of the professional arena that gets updated news on this have the news of it, it's too late. The profit has gone. So you got to be careful. And then people say, well, hang on, how do we make profit? Well, this is what you do, right? You invest in large pools of shares, which are called unit trusts, right? And that's the main element of for investment vehicles. And so a unit trust can comprise of anything from 150 to 1,000 shares, right? Good or bad, doesn't matter. And they can have varying, they can get quite complicated. They also do bonds, they also do property, they also do various other bits and pieces. And what that does is it significantly lowers the volatility risk of that person's investment. And they've bought one unit share as an example, which we wouldn't do because we generally make a portfolio of them so that we can manage the risk appropriately. But let's just say they bought one unit of a unit share thing. That's going to be significantly less volatile than a single share, basically because it's got all these shares in it. And there's generally, if you're not doing a kind of a passive investment, which you can get into, but it's actively managed by someone. So someone's managing the risk of that portfolio so the volatility doesn't go up and down. So that's the first place to go. If you want to manage your emotions, go into that. But people still get scared, right? So they're still looking at it. And they're saying, okay, well, it's dropping because it'll still drop and still goes down. And if it's dropping, I must sell. Or if it goes up, I must sell to take the profit. And that's not necessarily the case because the longer you hold the investment for, the better your chances are of getting a better return. Every graph you look at on the stock market, if you look at a 100-year graph, it's going up. If you look at any 1 month graph, you can get it going down or sideways or up, right? So the general trend over a long period of time it has been positive for quite some time. There have been bear markets, so there's been times where it's come down. But yeah, so time in the market. And speak to advisor. Managing your emotions is impossible. Don't try to do it with your money. Rather have the plan. Make sure you have the tax efficiencies, understand the goals you're investing for, and then speak to the person you're entrusting that plan to put it into effect and manage it that way. So much easier, And if you want to invest in single stocks and Bitcoins and things, then expect the expect
so
up and
just
down.
like you said, you need to calculate. You need to make calculated risks, right? You need to understand what you're putting your money into and basically where it can go. So studying it includes studying the history of it, studying the volatility of it, not just based on hype or emotion, like you said.
But also,
so
if you
if you're
use an
looking at
sorry,
if you're looking at jumping into things like the real estate, or if you're considering a separation of between where to put your money, if it's real estate, stocks, cash, index funds, fixed deposits, what would be your approach there? Now we understand. Now let's say there is an understanding on how there can be purpose for different things. How would you look at it?
So and it's a good segue, thanks, because one of the things that you get when you invest through an intermediary or an investment manager, you do get access to assets that are not available to the general public because they need a level of understanding to ensure that they are right for the person that lay people don't have unless you've done the education, right? And I'm talking here around things such as commercial property or gold or precious metals, or all of these kind of things are available if they're suitable. The commercial property one is an interesting one because that's in most portfolios. So if you see a property unit trust or what we, I won't go down there, but property unit trust, then that is made up of commercial property, not retail property. So it's not buy-to-let homes that people live in. This is shopping malls. It can be mobile phone masts. It can be, various high-rise buildings, office parks, things like that, which gives a longer-term yield, is more stable, and generally less volatile, right? So, and it's good. How we look at the breakdown of a portfolio is a science in itself, and we that'll take me days to go through. However, very quickly is we look at the risk basis, and then we look at how asset classes kind of interact with each other, because we've seen it over the years. Yes, it doesn't always hold true, but there is a certain way. So a bond, which is an asset class that is effectively a loan to a government or a company, and then they pay you interest on that over a period of time. And at the end of a period of time, they give you the money back, which is a bond, right? You have a 5-year bond, 10-year, 15 bond. Generally does the opposite to equities, which is a share that's traded on the stock exchange, like Tesla or BT or anything like that. Why is that, though? People say, well, why? Why does it happen? Well, because of the interest rate. So a bond pays out an interest rate. It's called a coupon, and that's reflective of the underlying risk of the company paying that loan back. And equities, and so with interest rates, if interest rates go up, bonds generally do better, right? Because they're going to pay a higher income out. However, equities generally go down. And this is a bit of an oversimplification, but we don't have much time. Why? Because the companies that are listed on these exchanges, it costs more for them to borrow the money they need to grow the company, right? So there's an added expense with high interest rates, just to be very simple. So, and that's, so they play. So they go generally opposite to each other. So if you want a higher risk portfolio, you have more equities and less bonds. If you want a lower risk portfolio, you have more bonds, less equity, right? You can see how we can balance that risk. We also balance it against what we would term a yield. If a person needs an income out of this portfolio, I don't want to derive income mainly from dividends, because those can be withdrawn from companies at any time and they're not guaranteed. So we'd look at deriving most of the income from something like a bond yield or a property portfolio that generates income out, right? So that's another way to look at it. Yeah. Because also remember, most of the return of a portfolio, especially in an equity portfolio, doesn't come from the appreciation of the share price. So it doesn't come from the share price going from £1 to £2 per share. Most of it comes from the compounding effect. And of course, we haven't even had time to talk about compounding interest, but it comes from the compounding effect of dividends paid by that company to the shareholders being reinvested. So you reinvest that, you buy more shares, next you get more dividends, you buy more shares, and so it grows like that. And that's where most of that return comes from. So it's very important. So with the bonds, you're getting paid that a yield. You're not buying more bonds, but that is going into the rest of the portfolio. So it can buy more units of equity or units of property, so forth and so on. Yeah. So that's how we diversify it, and we look at the specific needs of the clients, and we can adjust that. And what we call the asset allocation, which is where we get the diversification, i.e. we determining what level of assets and where they sit, accounts for most of the return. And people say, but hang on, isn't it the actual underlying investment? But no, it's not. It's actually the asset allocation, because if we get the asset allocation right, then we can expect a certain return based on that asset class coming in, because we're using unit trusts, which have a large pool of underlying investments. And now you can start to see some of the complexity behind what a professional investor does, right?
Yeah.
As to a person going on the internet and just having a look and saying, "Oh yeah, I like this." So it really pays to have someone who understands this looking at it correctly.
That's
Yeah.
why you should. That's exactly why you should consult CS Jones if you're looking at starting investments,
Something like that,
or talk to Chris if you think you have a bit of extra money that you want to, increase or multiply down the line. And yeah, I mean, investments at the end of the day, it's just a gift you're giving yourself later down the line in your life. And just like you might see it as a sacrifice right now, but you also will you never know what type of necessities or urgent needs that you might come across in the future. Depending on your lifestyle, you need to increase your you need to increase your wealth, you need to increase your cash flow to just make sure, even if it's a simple lifestyle, you need to make sure that you're safe in terms of financial aspect.
and never chase. Sorry, Tim. Never chase returns.
Go ahead, Chris.
Never try and invest in the highest returning assets, because you'll always lose. Never chase a yield. Never chase returns. Remember that last discussion, I think was in the advert, is it's always behind us. We need to know it's tomorrow. So diversify, expect a normalized return. And if anyone knocks on your door, phones you, or sends you a text or an email promising a return in the future, it is a scam. Delete it, ignore it, or do not talk to that person. Or definitely don't give them the money.
Yeah. Absolutely. I mean, yeah, you need to make sure that, like, just like Chris said, if you are now trying to understand, if you missed the point, make sure you check our YouTube page out. You share this video with your friends, your family, anyone that you think should could use a bit of know-how in terms of investing, starting their investment journey. This is Chris and Tim on the Buzz. We have you every Thursday from 12 to 1. Talking about finance, talking about how to improve your wealth, filling up your pockets as well. We've got pensions next week, and we're going into estate planning the week after. Make sure you have your questions ready before the show if you are joining in. This is Tim and Chris on the Buzz again. Thank you everyone for joining in. But just comment, share, or reach out on Facebook, Instagram, YouTube. Let us know what your questions are with Chris, and we'll come back to it next week. Thank you, Chris. Appreciate your time.
All good. Big match on Sunday.
Right. Yeah. Looking forward to it. What's your prediction?
We've got to go for England, right?
Absolutely. I'm just hoping. I mean, there's no way. I mean, if the match wins, basically, considering the whole precautions, the COVID precautions and all that, people are just not going to bother.
Look, I'm staying at home, so I'm not going out. So we'll be safe in the lounge.
Yeah. It's best to do all your necessary shopping, and just stay at home for about 2 weeks right after. Give yourself home a rest.
Good stuff.
Thanks, Chris. Appreciate the time. All the best.
Bye.